the Office of Professional Practice of Kroll in Philadelphia. She's also a Kroll Institute Fellow. She has over 25 years of experience. She's also global leader of Kroll's Valuation Digital Solution Group, which produces the cost of capital, readership content, and data housed in the cost of capital navigator. And having said this, Kevin is also director in the Valuation Digital Solution Group. He's based in Chicago, has more than 10 years experience in financial service and project and product management and financial analysis. And he's also a leading contributor to the content and data in the cost of capital navigator platform. And I'm happy to welcome you for our part 2 session on the Kroll beta tool and the new beta tool. We had a session in autumn last year where we would have a look into the toolbox and the analysis and the content. And today, thank you, Carla and Kevin, that you prepared a case study with a European company to run all these selection processes for a concrete case study company. Thank you. And having said this, I turn over to Carla and Kevin. Thanks.
Thank you.
Thank you.
So Kevin, why don't you get started with the case? So we thought about doing a case study where you need to select betas for a subject company. So I'm going to hand it over to Kevin to walk through the parameters of the case study we're doing. And then we'll also show some screenshots of how you do it. And Kevin can show his actually live screen of at the end of what it would look like in the tool. But the point here is to walk through some of the issues that you may already be familiar with and some you may not be familiar with when trying to select company, individual company betas for your WACC calculation. So we hope that this is helpful to you, not just about the tool, but in general. All right, Kevin?
So our case study today is regarding our subject company, Kroll's Food Store. It's our company owns over 1,000 supermarkets, stores, and 1 hypermarket. It operates in France and it also operates in other countries in Europe. So we started our search by looking at a few different industries, and we focused our search into 2 different industries defined by GICS code. So the first is going to be food retail, and the second is going to be hypermarkets and supercenters. And we've also, in our case study, we know we're valuing Kroll's Food Store as of December 31st, 2022. So at a high level, what do we need to define and things do we need to generate to estimate our beta? So the first is going to be, what is the currency of our discount rate or WACC? And where is our subject company located? So as previously defined, our company is in France, and we're going to be valuing our company in euros. The second is, what is for the beta, what is our time period for the historical returns? What are they going to be measured in? In other words, how far back are we going to be looking at for deriving our beta? In our case study, we will look at 5 years. And the next, we'll need to know what is the periodicity or the frequency of the total returns that we'll be measuring in the beta. In other words, we can look at weekly or monthly returns. And here we're going to look at monthly returns. So in other words, we'll have 5 years of monthly returns or 60 months of data in our look back period. And last is with our comparable companies that we'll eventually get to, we're going to need to regress those against a market index. So as our subject company is in France and has operations across Europe, we've decided to look at the MSCI All Country Europe Index.
And I wanted to add a note here. So a couple of things that are different from, the readily available betas, sometimes that you'd go into Yahoo or Google or something like that. We actually use total returns because a company's stock performance. It is based on not just on capital appreciation, but also dividends, if there are any. So in order to make an apples to apples comparison with any index and with a company's index, we use total returns as the measurement. Now, the other thing is here on the market index, as Kevin said, we're looking at a company that has operations across Europe. And so the temptation of many times that people have is to just use the index in their own country to regress betas. So because we said this company is actually based in France, the temptation might be to say, I just want to use a French index, maybe the CAC 40 or whatever that case may be. But what you have to see is that we're looking at the business risk of the operations of the firm. So it's important to match that with where they're located. And they're not just located in France. So if you just look at France, it might not be the right, and sometimes it won't make a difference materially on the betas, but sometimes it will. And you also have to be very careful about some country indices that are not large enough in terms of constituents. And so they might be dominated by a couple of industries, and it might be skewing the betas. So in these situations, you actually want to go broader with the index to match the business risk, the underlying business risk. That's what we're trying to measure, the underlying business risk for this company relative to the overall index. And so, in this case, the reason why we decided, a lot of people sometimes talk about MSCI Europe, we actually, because now operations are actually more broad than just Europe, we're using in our tool MSCI All Country Europe, which really what it means is that at the bottom, that footnote there says that in addition to developed markets, we also including Czech Republic, Greece, Hungary, Poland, and Turkey. So because these are clearly markets now that are being used across the board. It won't make that much of a difference, but that's how we're taking it. The second thing I would say is that we are using MSCI family of indices for the entire thing, for the entire tool. And the reason is because index providers have different rules on how they construct indices. And we wanted to make sure that there's no difference in beta just because of different methodologies on indexation. So by using the same family of indices like MSCI, which is a major provider across the globe, that way we can make sure that the betas are consistently being determined based on the same index provider. So with that, Kevin, take it away.
So again, we just answered really 6 high-level questions that are going to help us generate a discount rate or WACC, as well as the ability to build up our industry CAPM beta. So that's the way we designed our tool. I'll give you a quick sneak peek of what the tool will look like. Again, we've answered what's our valuation date, what's the currency of our analysis, where's our subject company located, the return frequency, monthly or weekly. We chose monthly, our look back period of 5 years, and then again, dependent on your subject location and the details behind your valuation, we have the option to select a couple of different market indices, again, based off of your subject location. So again, our case study is really kind of mirrors what our tool will be able to do. Carla, I think you were gonna.
Yeah. So when selecting comparable companies, we want to look at first which industry you're dealing with, or industries, right? Might be more than one, and then there's other things to help you tune down or get to your comparable companies to reflect the best business risk that it's comparable to your company. So things like geographic segments, product sales mix, and company size are all things that you should be looking at. Now, we don't have all of these items yet in the tool, but we already have a number of them. So as an example, you can search by keyword. So we put like a GICS code there, but you don't have to know GICS codes. I mean, you can just type in the description of your industry, or you can use keywords that there's a business description in order to search. We also tell you if, for example, if a company hasn't been traded enough, like long enough for the period you selected, there's a warning. So if you can see in that example, I know it's very small, but there's one that has a red font that says, oh, I only have 30 observations and I picked the 5-year observation. So you have to be careful, like if you're going to select that. Importantly, you can select based on size, metrics of size. So we show, you can search by market cap, by total assets, by EBITDA and sales. Also, you can search for country of headquarters and country of incorporation. And the reason why this matters is because sometimes you do have a very different country of incorporation versus country of headquarters. The perfect example are usually Chinese companies, where they often, like an Alibaba or a Baidu, that they might be incorporated in the Cayman Islands, but most of their operations are actually in China. So you want to pick something related to China. But there are other circumstances that you want to look at the country of incorporation. So we give the option, both of the options, to make a selection if that's what you're looking for in terms of country. Okay.
Looks like we have our first poll question.
First polling question.
Yeah.
Hopefully people are able to respond soon. And Shanda, tell us when we can proceed.
Oh, Carla and Kevin, you can continue proceeding.
All the time.
Yeah, you
We don't have to pause. Okay, perfect.
Okay.
Thank you. So Kevin, the next slide.
Yep. Oop. Just a little bit larger. So we can keep going. Okay.
So in geographic segments, for example, what we're talking about here is we looked at one example. Obviously, you would want to look at all of the companies you're selecting that you came up with, like as a first cut. Here is an example. Carrefour, has a lot of operations in France, but also in the rest of Europe. Kevin, if you click the next slide, it tells us that about almost 74% of sales are in Europe, which that would be, for example, a good indication that it was, in terms of business risk, would be similar to our Kroll's food company. Another metric to look at is those are going to be industry specific measures. So in the case of retail stores or supermarkets, you want to see the number of stores they have, right? But obviously, depending on the industry, it's going to be different things. It could be in pharma, how many products they have in the pipeline, or it could be, different metrics that are very specific to a certain industry. But that's something that you might also use to try to narrow down the companies that would have the business risk closest to you. So in this case, Carrefour, it is a really large store, and in this case would say, okay, they have 12,000 plus, almost like 13,000 stores. Now, sometimes there's not very good comparable companies, so you have to overcome this. Okay, I know this is not going to be as small as my company, but it's still, for other business risk reasons, this might be the best or one of the best companies to compare myself against. But that doesn't mean that if there are plenty of them, then you can narrow down to this level. If there aren't, you may be still stuck using like companies that are bigger than your subject company. And then finally, the business segment. So we're talking about product mix all along, right? And if they have a lot of other businesses that you're not in your subject company, then you're running the risk that you're not getting a pure play. And it's going to happen. There's always going to happen that you have a subject company that is very unique. In this case, we were looking for retail revenue, supermarkets, and Carrefour is just in the business of like retail stores. They don't have other businesses, but there will be other situations where, you know, they're broader than you, your subject company, and you have to make a decision whether it's a good proxy for business risk. Okay, and so, you know, we don't go through this process of all of these subject companies to walk through it, but for this example, we narrowed it down to these 5 companies, and we could have gone longer, but we didn't want to overcomplicate the example. So we remember when we said in the beginning that you could search by size when you're looking for companies. We're looking at, you know, metrics here of market cap, market capitalization, sales, and total assets. So in this case, we're showing, and throughout the example, we'll do this. We'll show in red the smallest of whatever the metric is for the comparable companies, and in green we'll show the biggest. I mean, it's not a good or bad kind of thing. It's just to distinguish. So by some metrics, like Jerónimo Martins, a Portuguese company, is the smallest in terms of sales and total assets. And Sainsbury in the UK is the smallest by market cap. And, you know, sometimes that has to do also with things like indebtedness, but or other reasons why the company. But so this would be another way of selecting, if you know your subject company, which we didn't give you a metric in the beginning, but you would have this for your subject company, you know, what ballpark your sales are or total assets, even if it's a private company and you don't have a market cap to compare it with. At least you can compare it in terms of sizes of sales and total assets. And there's also EBITDA, but, you know, these are probably better metrics for size. The one thing I wanted to highlight here is that we convert everything into the same currency. For whatever you selected in the beginning, that's the currency of your WACC, because otherwise it's hard to tell, you know, what one currency means against the other, right? So you may have Polish zlotys or British pounds or euro or US dollars, and then you wouldn't be able to really compare the size one versus the other. So in this case, right, everything is in euros, so you can truly compare the metrics against each other.
Okay, so now we have our comparable company selected. We're able to generate in the tool as well in this case study for 5 different beta estimates. But before we look at the levered betas, we can step back and in the tool and in the case study here, we're going to look at the statistical quality of betas. So these different measures of beta quality are really derived from our OLS, or ordinary least squares beta. So our first method of looking at the statistical quality is our adjusted R-squared. And that's really just a measure of model adequacy or efficiency. Our second is a standard error, and that's an estimate and a measure of model accuracy, where we look at the variability of what the actual data is versus what was produced by the regression equation. The third is going to be a t-stat, and that's going to be a measure of dispersion from our statistical hypothesis test, which can be used to really deem if a beta is statistically significant at various confidence levels. So here we're looking at a 95% confidence level, and these betas again are going to be all statistically significant based off our OLS beta.
And so if I could add a couple of things here. So we're showing adjusted R-squared. Now, when you're using historical betas, that is just one single dependent variable, R-squared and adjusted R-squared are the same. So the reason why we have adjusted R-square in our tool is because we have a different measurement of beta that requires two variables, which is called sum beta. And Kevin will talk about those in a sec. But if we go back up, that's the reason why we have adjusted R-square. But the adjusted R-square is the same as R-square for an OLS beta. In terms of standard errors, obviously we want it to be small, means that your variability around the OLS beta estimate, that it could be plus or minus that number. The smallest it is, the best. But as Kevin said, like we have different statistical significance. That's why we have the t-stat to see if the beta coefficient is statistically significant. And we have, up to the 95% level. But that's something that, to help you make the selection. In this case, they are all significant. But if they weren't, I would consider throwing it out, just because it has a good, description of business risk, that it seems like it's a good comp for you. But if it's not statistically significant, I would be very careful about selecting that beta in your final conclusion. Go ahead, Kevin.
Okay, so our first beta estimate is, again, going to be the OLS, or ordinary least squares. That's going to be your simple slope function, a very simple linear regression. The second, as Carla was saying, is our sum beta. So that's adding a second variable into the regression. So in other words, a multiple regression here. And the idea here is we're adding as the second variable lagged market returns. And again, the concept is larger companies tend to react better, or in part, quickly in market movements versus smaller companies. And you could think of like the example of, Apple. It's got hundreds and hundreds of equity analysts versus Fred's software and hardware shop, much smaller, similar industry, but their news and their movements aren't going to be as quickly responded to in the market. So again, here's the sum beta is going to be more appropriate when looking at smaller companies. The third is going to be the Bloom adjusted beta. This is kind of like a one size fits all adjustment. And the idea here is that betas over time will move towards the industry, or in other words, a beta of 1. So it's a simple adjustment to the OLS beta, moving those betas towards 1. And then our last is going to be our Vasicek adjusted beta. Similar concept where statistically low quality betas are adjusted towards their peer group. Okay, and the peer group here is going to be your average of your comparable companies in this set here.
So a few more comments on this. We have included in the appendix, which I know then these slides will be shared with you, but we have included in the appendix the definition of sum beta, Bloom adjusted, and Vasicek, so that you see it's very transparent, like what the calculations are being done. And a couple of notes. One, the Bloom adjusted is what people who have access to Bloomberg will know as the Bloomberg adjusted beta. Now, Bloomberg makes it a very simple adjustment, and they say 2/3, 1/3. 1/3 is I move my beta over time will move to the market beta of 1, and 2/3 will be my underlying historical beta. The actual ratio is slightly different from Bloom's paper from the early 1970s. And so we at the end, we show a quotation and the actual summary. Now, I am not a huge fan of Bloom in the following sense. I mean, if you actually read the paper, which I have, the 2/3, 1/3, and I'm just using 2/3, 1/3, but it's not exactly, it's more like 0.37, something like that. It's based on an average of various periods. So what Bloom did is he looked at the data from 1920s all the way till early 1960s. And he said, if I do rolling betas, monthly betas over 7-year periods, the ratio towards the move towards 1 is different in every single decade, but I'm going to average everything out. And then he said, but be careful, because in the future, they may move at a different ratio. And sometimes we're actually introducing more error to it than compensating for individual company beta uncertainties. So the one size fits all is always an issue that, I understand some people use it. I have a little bit of an issue with that. I much rather would do a VASI-check beta. And VASI-check is also called the shrinkage method. And the shrinkage method, because it's saying companies that have a higher standard error, they're like, there's more uncertainty around the estimate, get a lower weight. This is a weighted average beta, and the companies that have better statistical quality would get more weight. And so the VASI check, and the thing about this module that we put together is that you don't have to do the calculations of all the standard errors and everything. We just do it for you. It's very automatic. And I think that's a better reflection, because it says that over time, the beta of a company will move towards its peer average, as opposed to saying it will always go to the market beta of 1, which is really not true for some companies. So, for example, regulated entities like in the utilities, like power generators, etc., they may never move towards the beta of 1. They may always stay under 1, and maybe technology firms are always greater than 1 on average. So to force everybody to come to 1 may not be the best, especially because we don't know if that's the right ratio, because the data from the economy and markets in the US, which is what this is based on, of the 1920s through the 60s, is very different with what financial markets are today. So but we provide it, don't get me wrong, we provide it, but I just want you to know the limitations. The other limitation I wanted was on some betas. As Kevin said, it's best if you're dealing with small companies. That will probably capture best the that lag effect, because what it means is that because if companies trade less frequently, it takes longer to reflect market news into the stock price. But when you're dealing with large companies, the sum beta is actually less relevant, because what happened a month ago is not important anymore. It's what happened now, this month, that matters. And so I would point out to you that Ahold, the sum beta is really low, right? And because what happened a month ago, it's irrelevant. And I would also give you a tip. That's something I teach our new hire training folks, is that if something is below 0.10 as a levered beta, chances are it's not statistically different from 0. And so to be using something that's small for a beta is probably not realistic. So if I was using, and I'm not suggesting we would use some betas at all, I wouldn't use it here. But if I were using some betas and I had this, I would throw out a hold, because it's just not meaningful. But anyway, so that's something to think about, the various types of betas and what might be appropriate. Kevin? Here, you should know our definition of debt to get to the capitalization, debt over total capital. Our definition is based on total debt, including operating leases. So as you know, with IFRS 16 for companies that file under IFRS framework, since 2019, they had to disclose their operating leases as well as their capital leases. And now everything is called finance leases. Now, that's not true in the United States. So if you have comparable companies that are in the United States, the operating leases are still called operating leases, not finance leases. And they are separately reflected in the balance sheets, but they have not gone through that extra step of separating the rent expense between a depreciation and a interest expense component. So a lot of times people who are doing WACs and DCFs in the United States, because their clients will not give them the separating the rent between depreciation and the financing, the interest expense component, they continue to use debt over total capital, excluding operating leases, because you're trying to make sure that your WACC is consistent with how your DCF was derived. For non-US companies, though, what makes sense is to use, including, we were calling it operating leases. Obviously, now it's called finance leases. But that's what we have right now. We will, at one point, give the ability for people to exclude it if they want to, but we started with what we think is the most appropriate from a theory standpoint, because these leases are a form of financing. But it does change the relative, weight of debt significantly. So, as an example, look at Sainsbury, like in the middle of the table, which, including operating leases, it's 60% of total capitalization. So it's actually very significant, and maybe that's why their market cap was also a little down. Compared or smaller compared to the other comparable companies, even though they had similar level of sales. But then if you exclude operating leases, it's only 14%. So it's very significant in terms of leverage, right? So that's the one thing that you want to, as I said, we don't have it right now. Right now, our debt over total capital is reflective of all the lease financing. And in this case, the median is 50% and the average is 46, which is quite a bit of debt compared to if you weren't considering the leases in the capital structure, right? Like if you didn't consider them, you'd be like 18th or to 25%, depending whether you look at median or average. The tax rates in our tool actually are based on the Tax Foundation, which provides worldwide tax rates, for, 190, almost 200 countries. Mm-hmm. And so we have that as a off the shelf, immediately available. And then the other thing is the credit rating, which is really not required to do one of the steps we're going to do when we're going to unlever or ungear our beta. So in order to come up with an asset beta, if you use Hamada, which is the method that is most used most frequently, you don't need to know the credit rating necessarily, although it's good to see where it is. But we will need it if we were to use Harris-Pringle, and some people do use Harris-Pringle to unlever betas to get to your asset betas. So we're showing it to you right here on our concluded credit rating of BBB, and this is based on two sources. There's the S&P official rating, but then we also use a S&P Credit Analytics credit models for that gives you the lower score, the lower letter rating, which is not an official rating, but it's based on financial ratios. And so that's what this is based on. Okay, Kevin. So here, Hamada is the traditional method, right? Like everybody uses that. Now, you saw that we had a lot of leverage. And so that has an impact on the unlevering solutions. And so what you're going to see here, and when we show you the Harris-Pringle, is that these betas tend to be lower because it's giving full credit to the tax deductibility of interest without any impact of potential risk, financial risk, or distress risk. The one thing that we look at in terms of unlevering, the VASI-check range, it tends to be a little tighter because than the OLS betas in terms of like the low and the high. But the thing is with using the unlevering, using operating leases, it does matter a lot for the kinds of betas we are looking at in terms of underlying business risk. So they were quite wider in terms of just the OLS and the levered betas. Now this unlevered or asset betas are a much tighter range. And if we go to the next slide, this is just so you have the formula, so you know what it is. And the Harris-Pringle betas are technically more correct from a theory standpoint. What Harris-Pringle says is that there is a certain risk associated with having debt in your capital structure. In other words, the Hamada assumes that there's no risk. You can have 99% debt in your capital structure, and there's no risk that you'll default, and there's no risk that you will not be able to use the tax shields. You will not be able to deduct interest expense for tax purposes. Well, that's not really true, right? We know that if a company gets into a lot of debt and has a significant amount of interest expense, chances are you're actually getting into a loss position. Your net income is actually a net loss. And that for tax purposes, you might not be able to use all of those interest shields, so interest tax shields. And so what the Harris-Pringle beta does is it says, well, there is a certain risk associated with the debt. It's not zero. It's having debt in the capital structure is not the same thing as having cash. And so the debt beta is an extra element that is needed compared to the Hamada formula. And so the question is, where do you get debt betas then to do that analysis? And this is full illustration. We do this in our other module, which will bring down the line, will bring this ability to our to the beta module. Right now, we don't have Harris-Pringle, but we're planning on adding Harris-Pringle to the mix. Is that we compute this every quarter, what debt betas are, and this is these are denominated in euros. So we have debt betas denominated in different currencies, and so this is and the thing is we use full letter grade rating. So we don't use notches. We don't do BBB plus, BBB minus. We use like the full notch because just of data availability. So as you can see, below investment grade, so the ratings that are BB, single B, and CCC, the debt beta is much higher than the investment grade. And so what happens is that this will impact your unlevered beta. Now, from a practical standpoint, I would say if companies don't have a lot of debt in their capital structure, it doesn't really make much of a difference. You don't need to go through Harris-Pringle. You'll get about the same estimate than under Hamada. But when you start getting into a lot of debt in your capital structure, you may want to consider a different unlevering formula. And so here, unlevering with using Harris-Pringle, the average and the median betas are a lot higher. So because we have, about 50% of debt in the capital structure. So it's a lot of debt. So it does have an influence on the results if you have a lot of indebtedness in your capital structure. So as I said, we're not going to, this is just to give you an example. This is not in the tool yet, but it's just to show that the unlevered betas are higher using this method because of the amount of debt in the capital structure. But it continues to be the case that Ahold seems to have the lowest beta of the group. Now, the last step is you're going to select your unlevered betas so that you can then relever, right, at your own company's subject company's capital structure. So this is using Hamada because we're going to show you just what we have in the tool as of at the moment, but we keep on adding more features. We're going to, after launch, we're hoping to launch, Kevin, at the end of this week, right? And so, but that doesn't mean our development efforts will stop there. We will keep on adding more features. And so one of the things we will provide, now we only have 5 companies here in the example, so maybe the range is not as meaningful, but when you have several more companies, this is something we provide that we find it's very useful, which is to say, we provide first and third quartile ranges, just so do you see where the betas from your comparable companies are ranging, as well as the median and the average. So all of this will be available in the tool. And then where do you pick your selection? I mean, you can go with the average or median, but if you think that your specific companies, that your company is more similar to a couple of the ones that are maybe on the high end or the lower end, then maybe you want to select a beta that is different, right, than just the average or the median. So that's just something to consider. We're giving you all of this, readily available, so that you don't have to do those calculations yourself. So in this case, the range for VASI-check is slightly tighter than the OLS betas. Not too different in this particular example, but they're a little tighter. Do you want to do this, Kevin, like the relevering assumptions?
Sure. Yeah. So to relever with the Hamada, we need a couple inputs. First is going to be our capital structure. So for our case study, we can look at our comps, which for here, it's going to be the median capital structure, a debt to total capital of around 50%, or in the Hamada, a simple way to view it as debt over equity, which is 98.7%. If we recall from the comps, the official or unofficial credit ratings were in the triple B range, and we use that as a proxy and conclude. Again, for a triple B, which is only going to be used for the Harris Pringle. And then for our subject company's location in France, we will relever to their tax rate, which the French 2022 tax rate is 25.8%.
And one thing is you can always change to your CAPM tax rates. I mean, we provide you off the shelf items, but if you want to override it, you can always do that. So here we just give you an example of relevering using Hamada, the formula, and we're showing you both the OLS, so the historical betas, versus the VASI-check. And in this case, they're actually not that different. When we relever the median, that's the median in the brown square is 0.7, and for the OLS betas, and the median VASI-check is relevered at 0.67. So there's not a big difference, but there are instances where there would be differences. And so this tool provides you all of the options to help you select a better beta when you're reaching your conclusion. And so the one thing we just want to leave you with, like a little tidbits of possible distortions when you're selecting betas in the current environment, the post-coronavirus, because a lot of betas saw meaningful changes in terms of risk relative to the overall markets. One is the asset beta unlevering method, which we actually highlighted. That Hamada may not help when, for example, you have significant equity market declines and suddenly debt is a significant portion of the capital structure if we're using book value. And so Harris Pringle at times might be a better option to unlevering. The second one is the capital structure issue, which we didn't go, that's not the issue about the tool, but it is something that to consider when you're looking at capital structures in the current environment, because when there's a big decline in market cap, you may see, if you're using book value of debt, you may see a disproportionate amount of debt versus equity. Now, there's two things. One is, we know we use book value of debt, and that's what we're using in the tool, but we need to understand that that's like a simplification. We're saying that book value of debt is a proxy for market value. During these times of upheaval, that's not always the case. That's not always true. And there are typical, I mean, certainly it's mandatory under US GAAP, but even in IFRS, typically there will be some fair value footnotes that will tell you, like, some of the debts, what is its fair value as at the end of the reporting period versus what is the carrying amount, the book value. So sometimes it's good to look at that, especially in an environment where interest rates have changed dramatically. So, and interest rates have been going up at a pace that we have not seen in the past, right? The 2022 surge in inflation across the globe. And what that means is that central banks are raising interest rates at a pace that you had not seen since the global financial crisis of 08 and 09. Interest rates are now back to that level. And what that means is, in a number of cases, if you have long-term debt in your capital structure of your comparable companies, the book value may not be equal to fair value. So that's just something to consider. Again, it's not part of the tool, but it's just some tidbits, some things for you to think about when you're looking in situations where things look a little odd because of like a depressed market cap for some companies. Okay, and I think, Kevin, the next is just to see. Yeah, go ahead.
Yeah, so just a couple of takeaways from our case study. Again, start with your comp group that closely reflects the risks of your subject company. So again, we went through the exercise of drilling down by industry, by size of various financial statement metrics, down to geographical and business segment risks. Also, consider using multiple methods to estimate your betas. And again, in our analysis, we honed down into using the OLS and VASA-check, and then be critical about the methods you're using and the results you obtain. So again, know the nuances between the various beta estimates, the pros and cons, and be cognizant of when you're analyzing and all the different aspects to your beta analysis. So now we went through our case study. We can do a quick snapshot of what does that look like in the actual beta module today. So this is in our test environment. I pre-populated everything that you would do here, but we can quickly run through to say, this is what we did in our case study. So we start off by selecting our general inputs. Again, all these are the same in our case study. We can see these are going to be the returns put into an index chart, and we can see our comparable companies. How do they perform against our market benchmark, which is our MSCI All Country Europe Index. And then we've gone down, we've selected our comps. We can add more to our analysis, up to 10. And then, once we selected our comps, we have our levered betas. We move on to the statistical quality of our betas. We get down to our unlevering inputs. Again, we offer the ability to use the tax rates from the tax foundations, or you can override to use a custom tax rate for each one of these comps. Then we get to our unlevered betas. Again, this is going to be using the Hamada method. And then finally down to relevered. So we can sensitize using the various beta methods that we have above. In the case study, we use the median debt to equity for our comp group, or we can go ahead and type in our own custom capital structure based off of our subject company's capital structure. And then the tax rate, again, our subject company is in France, where we've used the tax foundation's tax rate, or you can type in your own custom tax rate, and we can see the progression. Again, I've selected OLS beta. We can see the progression from levered to removing debt to our unlevered beta to re-levering based off of, here again, the comps, but our subject company's capital structure. We'll have the ability to export all your results into Excel. It will capture all the information you see here in the application. You do have the ability to edit these inputs. We can sensitize, well, what happens if I use weekly returns, or if I want to change my currency to something else, et cetera. There'll be a lot of future features coming down the road. Like Carla said, the ability to exclude operating leases from total debt. We'll be able to save these analyses. So if you want to come back and edit your analysis, sensitize it, we'll be able to have the save feature coming down the road. One thing that we're really looking forward to is this is your beta snapshot as of this date. We'll have the ability to look at these betas over time. So we call that our trends over time feature, where you'll be able to click on a beta estimate and you'll see all your comp group, how those betas have reacted over time. So those are just a few of the features coming down the road.
Yeah, I'm looking forward to that one, because I personally, like after COVID, I saw a big difference in how betas change for some industries. For example, retail, it jumped up above 1 significantly. And so that's something for some retail stores, not food stores, but I think that feature is going to be very, very helpful. I think with this, we're reaching to the end of our presentation. I didn't see any specific questions. I don't know, Wolfgang, if you have any additional questions on what we saw.
Yeah, thank you, Carla. Thank you, Kevin. Any questions from the audience? Not so far.
I do have one question that I get a lot is, what does it matter that you selected the currency in euros? And the reason is because you want to make sure that you're not including FX, so foreign exchange fluctuations, in your beta. So when your index is denominated in one currency, all of them should be also based on the same currency, because otherwise you're going to have a disconnect on the betas. So what we do in this module is we make sure that even if a company is trading, say, in British pounds or some other currency, all of the returns are converted into the currency of the index and the currency that you selected. So everything is internally consistent. Everything is correctly computed, which a lot of times people don't realize that you could actually have very different betas if you're not careful with the currency of the index versus of the trading.
Yeah. Tim has, he mentioned one point. I think he's talking about the debt beta, and he was surprised that for C and B rating for both, I think the debt beta was 0.43 for both rating classes.
Yeah, and that's an interesting observation, because in euros, the way we compute the debt betas is there's not enough data for the below for the Europe and world set for below investment grade. So we end up doing all of them together. Because of debt data is a lot less than for equity. In the US, we actually have different debt betas by single B and double B, etc. But for globally, we just use the same for below investment grade.
Okay. I have personally two questions. You talked about your leverage and unleveraged, and you used the term total debt.
Yes.
what about cash with a beta of 0? I'm aware of a lot of evaluators in Europe who use net debt.
Yes, and it's a great question. I mean, we are planning on adding. Remember, like the extra features, we want to add a net debt feature so that you'll be able to deduct cash. But we'll also add a different approach, which to me is a preferred approach, which is if you think there's a lot of excess debt in your capital structure, you could use the formula that Professor De Moderen puts out there, which is to say a zero debt beta or zero cash beta. And so, but you don't do both. If you only use the adjusted beta for cash, if you're using gross debt, or you just use the net debt approach, and we want to add both.
Okay, great. I personally prefer the Moderan's way because you don't mix debt betas and cash beta effects in one formula. So it's much clearer. It's easier to understand for everybody, I think.
I totally agree with you, Wolfgang. That's my preferred method. I mean, I'm not going to be able to prevent people from doing their methods, but my theoretically preferred method is what you just described. Okay.
Yeah, and maybe also one topic you can think about in the development. You talked about a lot of statistic measures. In Europe, we have the challenge that we have a lot of small stock listed companies with very poor liquidity. So at the very end, these betas for these companies, they also have poor statistics, but we also use some liquidity measures like bid-ask spreads or something to get a view on this liquidity topic on stocks.
So we try to get that solved through the issue of sum betas. So sum betas is also called the Dimson beta, because originally there was Dimson worked on a paper that and we do have relationships with Elroy Dimson because we are doing a size premium analysis for the UK. And he definitely, suggests doing this for a lot of European companies, and we're doing that for example, for the UK companies. And I think that some beta, even though it didn't work for the examples that we picked because they were really large, I do think that some beta will be relevant for those companies that don't have a lot of liquidity. The other thing I would say is that you'll get more problems if you use weekly betas with very small illiquid companies. So the betas might be too small. So in those cases, when you're dealing with really small companies, illiquid companies, it might be best to use a monthly better measure of risk than using the weekly betas, which we have both. We just didn't show it today.
Okay, thank you, Carla and Kevin again.
Thank you.
And thanks to the audience. We welcome you to our next Around the Valuation World show in 4 weeks on April 24th. And our expert will be Dr. Ashshot Abbott, and he will talk about DLOM and some interesting topics around DLOM. Thanks again to Carla and Kevin and Chanda for your support, and Andrew, and have a great day, great evening. Goodbye.
Thank you, everyone.